Are you a gambler? Would you bet $7,000 that interest rates aren't going to go up in the next 20 months? Okay, so that's the question of the day. Would you bet $7,000 that interest rates will go up by at least 1% in the next 20 months? Here's what we're talking about. We're talking about 2-year mortgage strategy versus the 5-year mortgage strategy. So 2-year fixed versus 5-year fixed. And which one will perform better over time? We know from the studies done by Moshmalovsky that typically short-term rates beat out long-term rates, but let's take a look at the actual numbers. Let's see what the benefit is in those first 2 years of taking a 2-year fixed. I think you're going to be surprised by the numbers. Let's go to the whiteboard. So let's take a look at the 2-year versus the 5-year rate. Now, we know that the 2-year is typically going to be lower than the 5-year, typically about 0.5%. So as of today's date anyways, the 2-year mortgage is at 2.54%. 5-year mortgages are at 2.99%. So this difference in interest rates is about 0.45%. And the question is, how much will this 0.45% save you over the first 2 years of the mortgage? And the answer is actually really surprising. On a $400,000 mortgage, for example, the savings will be about $3,500 in principal, and it'll be another $3,600 in interest. And this is just over the first 2 years. So for a total savings of about $7,100. So this is where that question comes in. Would you be willing to bet that over the first 2 years of your mortgage, would you be willing to bet $7,100 that rates are going to go up more than 1%? And actually the break-even number on this, so let's say after year 2 you were to get another 3-year mortgage to bring it up to 5 years, so the equivalent of the 5-year at 2.99%. Well, if you got an interest rate that was lower than 3.8%, you would win. So in other words, in order to break even, interest rates have to go up by 1.3%. So do you think interest rates are going to go up more than 1.3%? That's the big question. And the answer is, it's probably not likely. So with the break-even point at 1.3% over 20 months, and the reason why we're talking about 20 months here instead of 24 months is because you can get a 4-month rate hold. So really what we're doing is we're banking on 20 months worth of interest rates that don't go up by more than 1.3%. If the interest rates don't go up by more than 1.3%, we're better off in that 2-year fixed mortgage. And let's call a spade a spade. Interest rates aren't going up by 1.3% in the next 2 years. It's not gonna happen. I mean, there's a chance it could happen, but the likelihood of it happening is almost slim to none. Here's why. The last time that interest rates were this low was in the 1950s, and it took almost 25 years for interest rates to go up just 5%. The reason why is when interest rates are low, small changes have big effects in the economy. You know, this isn't like the 80s where at 10% interest rates, they raised interest rates 5% almost overnight. You know, at 10%, a 5% increase is essentially the same thing as a 0.5% increase at 1%. And very rarely over a 2-year period will interest rates actually go up more than 1%. I mean, think about it. Over the last 7 years, we haven't had one rate increase. And let's call a spade a spade. The economy's a little bit better, but it hasn't really changed a lot. Things aren't overly amazing in the Canadian economy. Inflation's at about 1.3%. Bank of Canada typically aims for 2%, so that tells us that there's no real reason why they would increase interest rates when inflation's still low. So would you bet $7,100 that interest rates are going to go up more than 1.3%? The smart money's on keeping the $7,100 in your pocket. In Jim Paul's book, What I Learned Losing $1 Million, he talked quite frequently about how the best way to make money is to limit your losses. Handing $7,100 extra money to the bank in the first 2 years is essentially the same thing as saying I'm willing to take a $7,100 loss because I think interest rates are going to go up. And the reality of it is the fear that interest rates will go up is nothing more than that. It's just a fear. And in most cases, it's irrational. So if the number one lesson is don't lose money, then that dictates that we take the 2-year fixed, we save the $7,100, we apply it to the mortgage, and we reassess in 2 years. We see what the economy looks like at that point. Then we make another decision because we know right now that we can practically make $7,100 just by taking the short 2-year term. Furthermore, if you go back to the 1950s and you look at 1950 to the year 2000, there was a 9 in 10 chance that you would be better off by taking a short-term mortgage than a long-term mortgage. So we're talking 1 out of 10 times the 5-year fixed rate one. I think this is another example of a really good time to take advantage of short-term rates that are 0.45% lower and get the savings up front. Because taking a long-term fixed rate instead of a short-term fixed rate is essentially the same thing as locking in $7,100 worth of losses. Going short on your mortgage is what saves you money. Shorter terms, variable interest rates, taking a mortgage that sure has a little bit more risk but a lot lower interest rate wins 9 out of 10 times. And as long as you can handle your budget, as long as you aren't worried about rates fluctuating drastically, and as long as you can weather the storm of maybe a little bit of difficulty in the economy, you'll be fine and you'll win and you'll have that mortgage paid off in 7 to 10 years rather than taking the full 25.